I'm speaking with Teiki Benveniste, Head of Wealth Management Solutions Australia with Aeris. First of all, Teiki, thanks for participating in the Inside Network's Alternative Symposium 2026.
Thanks, James. It's always a pleasure being part of those events. Very well run.
Teiki, private infrastructure has grown hugely since the GFC. Why is it still a compelling asset class today?
Well, actually, I would argue that it's becoming an even more compelling asset class today. When you look at the growth in terms of investments made into private infrastructure, since roughly the COVID crisis in 2020, we've seen a doubling, so times two, the number of investments made in private infrastructure in the US alone. And it's because of structural changes that we've seen happening in the economy, where basically our lives are being moved to the cloud. Everything is being digitized. That means on top of the AI revolution, we're in a situation where the need for data is becoming expansional. The need for power to support that expansion of the need for data is also growing, and that requires a lot of capital. And so today, we're in a situation where the capital required to support that growth versus the capital available that's being invested, there's actually a huge imbalance, and we think that creates an amazing opportunity for investors.
Why focus on operational cash flow generating assets rather than development risk?
Yeah, so I mean, as an investor, we can go up and down and do both, but we feel there's an amazing opportunity for investors in core assets that have been de-risked. So you're not taking construction risk, you're not taking development risk, but those assets are operating, cash flowing, have long-term contracts with off-takers that are credit worthy. And really from an investment standpoint, you're taking on core risk, which is an attractive level of risk. You know, it's assets that basically are not going to experience a lot of volatility, shouldn't be impacted by cycles, and where your returns are anchored into those stable cash flows, long contract cash flows with credit-worthy counterparties, so that you can underwrite your investment thesis on something where you're not betting on an appreciation of a price. You're just looking at those cash flows and anchoring your returns and your investment thesis on those cash flows.
You mentioned some of the thematics around such as AI, digitalisation. How should advisors think about those kinds of thematics as drivers of infrastructure demand, and why is it attractive in infrastructure compared to, say, listed equities or even VC?
Yeah, so I think for us, the way we view it, again, it's about risk-adjusted returns. You know, how can you deliver to investor a 10% return, mostly generated with yield in the infrastructure space? And AI and the demand for data and effectively the demand for power is kind of like the underlying current of supporting the opportunity. So let me take you through this. If you think about the amount of power that needs to be created between now and 2030, the capacity that needs to be created in the US, you're talking about 500 gigawatts worth of additional power. That's about a $2 trillion investment needed for that additional power. How is it going to be realized? Well, developers, people that actually take on that development risk, take on that construction risk, will need capital to go and build that new capacity. And to do that, they're selling core assets that have been built, that are cash flowing, and they're selling those assets to us. And so we love that way of playing that thematic where we're investing in the picks and shovels, we're investing in the de-risked assets and getting cash flows for it.
Let's talk about structures. What is changing in that area in terms of now semi-liquid, perpetual structures, not superseding the traditional drawdown fund yet, but certainly becoming more prevalent? What's driving that?
I think first and foremost is the ease of access for private wealth investors. If you have an evergreen or semi-liquid fund, that's available there when you can come in every month, where you are deployed from day one, it's probably a more enjoyable experience than being in a closed-ended fund where you get capital calls, where you don't know when you're going to be called, and where the deployment might not be so obvious. So we feel that for private wealth investors, the access is more is more attractive. And then for assets that are having a 30 to 40 year useful life, where you don't really want to be selling those assets anytime soon, being in an evergreen fund where people can come in and benefit from those cash flows, we feel is a compelling proposition.
What kind of conversations do you have with advisors around where they should position infrastructure in a portfolio, given things like the correlations, the defensive qualities, and the yield profile?
Yeah, so I think there is infrastructure and infrastructure. It depends what type of strategy you have. You can be doing core plus, you can do value add, and that's going to have a different role in portfolios. The way we are playing it or investing in this opportunity is via a focus on core assets and yield. So having that in mind, we think that a strategy that does that can benefit investors in a few ways, which is diversification, making sure that you reduce volatility in your portfolio, but also, and probably most importantly, act as a yield enhancer to your overall strategy.
Teiki Benveniste from Ares, thank you very much for your time today.
Thank you.